Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully all of you had a very good weekend. And in today's markets, guys, well, I guess you know already, the damage has been done. Today was a very heavy day of momentum-based selling as the unfavorable narrative surrounding Trump's new policies, namely around tariffs, simply continues to weigh on equity prices. Now, the reason for the most recent sell-off today, it had to do with an interview that Trump gave Fox yesterday on the Sunday period, in which he said that a recession was not off the table. At least that's the narrative that the media is running off of. He actually didn't mention those words, but in today's video, we're going to recap exactly what was said yesterday, which led to a lot of selling pressure into today's action. Now, as I've reminded you guys, the market is truly based on narratives, and the narrative at the current time is one of expectancy, not so much of real-time data right now. Are certain data points still struggling, like sticky inflation and a labor market that, although is not strong, also is not weak? Yes, but is the sell-off warranted by any fundamental data that we have now? No, it is largely a game of expectancy and of narratives right now. The media is making you believe that the expectancy for the next 1 year moving forward is going to be one of an economic pullback, dare I say an economic recession. So in today's video, we're going to go over a few things. Number one, we're going to recap those comments made by President Trump yesterday when he was speaking to Fox News. Number two, we're going to be going over some analyst comments as to the direction of the markets recently and what they expect to see moving forward, and then put it all together and give you my opinion as well. Thereafter, we have some earnings to cover, guys. Number one, we are going to be covering, well, only Oracle, as a matter of fact, for today. They had their earnings after the bell and are up right now ever so slightly in the after hours, despite posting fantastic numbers pretty much across the board, but they missed on a few key metrics. Thereafter, we're going to take a look at our technical analysis and see, with the SPY and the QQQs having one of their worst days since 2022, cautioning a meltdown and arguably some form of retail and momentum capitulation to the downside, is it a good idea to be selling everything now when the QQQs have reached their most oversold point since that same time period, or one of the time periods in 2022, and the S&P 500 futures also coming into the most oversold short-term territory that they as well has been since 2022? Is it a good idea to sell down here? Or if we're looking to get out of the markets overall, should maybe we be waiting for a bounce? Or maybe is it just better to stay in the markets altogether, right? That's what we're going to be looking at in the technical analysis, as several indicators are now in deep oversold territory, which could result in a short-term bounce. So on today's menu, guys, we have a lot of things to talk about. Let's jump right into it, shall we? So the SPY is down 2.66 to end the day. The QQQs are down 3.88%. At one point today, guys, the Qs were down almost circuit breaker territory. Top to bottom move since the Friday close, 4.72%. We have not had one of those days, as a matter of fact, since 2022, as the pessimism amongst investors climbs in the market, right? So overall, the heat map, guys, you will see that it was not good. Once again, an unwinding of the infamous AI trade. The same growth trade that gave us tremendous gains in 2023 and 2024 has now been unwound in a very rapid fashion over the last 3 weeks. We also have declines in big names such as Walmart and Costco. Walmart down over 4% today, an unwind in the banks after their phenomenal rally after their Q1 earnings. Credit cards getting hit equally as well. Healthcare was a mixed bag today. Industrials, which started off the day strong, ended largely in the red. Even real estate, which started very positive. A lot of REITs were in the green this morning, giving back all their gains. Utilities holding strong, and some names in consumer defensives also holding up the gains for the day, but retracing a large amount into the end of the day close. On the one-day relative performance, that gives you a heat map that looks like this pretty much. Only utilities and energy to the upside, led to the downside by technology and consumer cyclical. Communication services as well, as that's largely comprised of Google and Meta at this point. Both of those companies were down over 4%. Sometimes you can't even see Google and Meta move 4% in 1 week. Now they're doing it in one single day. Tesla down 15.5% today, a very, very, very strong number overall. And we're going to get into it a bit later, guys. The unwinding of the AI and growth and hype trades. If you take a look at this options list right here, yes, I have Ethereum and Bitcoin. We'll put those to the side for now. All of the names that were down the most and have been down the most in the last 3 weeks, you can see a common theme. Reddit, which had a tremendous rally, now that one down top to bottom, 52% in just 3 short weeks. Robinhood, another fan favorite one that saw incremental growth and then exponential growth towards the end of its rally. That one is down 45% in just a short amount of time. Coinbase, largely following Bitcoin to the downside from its top, 48%. MSTR, no secret here as well. That one's down 56%. Tesla, which also saw a lot of hype leading into a culmination high, 54% from the highs. SoundHound, same thing. Look out below, guys. 66% from the highs earlier in January. AppLovin, another one that a lot of people wanted to chase at the tops, and I was advising against it, now down 55% in just a few short weeks. Even SOFI, which had a tremendous rally based off of retail investor interest, down 40% from the highs. I think you guys can see, and even Palantir, everybody was wanting to FOMO into Palantir at the tops here or back here. Now that one down top to bottom, almost 40%. So you can see a common theme here in the markets of what exactly is being unwound. We are getting rid of a lot of froth in the markets right now. So before we look at more technical analysis, let's first dive into exactly what President Trump had to say in that Fox News interview yesterday, which led the media headlines to run with a tone of Trump is not ruling out a recession. He never quite said that, but that is what the media read between the lines. So here we go. Trump said a transition period for the economy is likely. You can't really watch the stock market. Let's move into it further. There is a period of transition, right? Here we go, right? There's a period of transition because what we're doing is very big, Trump said Sunday on the Fox News show, Sunday Morning Futures. We're bringing wealth back to America. That's a big thing. It takes a little time, but I think it should be great for us. The question was, do you think the U.S. economy is going to go into a recession? That was his answer. So he didn't necessarily quell any fears of a recession, but he didn't also say that a recession was on the table. He kind of gave a non-answer. However, the media headlines ran with it, and pretty much all across the board, you can look into it. They were saying that Trump is not avoiding the possibility, or Trump is not saying that the possibility of a recession can be avoided, focusing on the term recession, which obviously spooked investors and both retail and institutions alike today. Asked whether he thinks a recession is imminent, Trump said, "I hate to predict things like that. Look, we're going to have disruption, but we're okay with that." Right? So he didn't necessarily quell the recession fears, but he also didn't rule out the recession fears as well. While Trump used Wall Street as a continuous barometer of his progress during his first term in office, measuring his success against the success of the stock market, he discouraged making it a yardstick this time around. "What I have to do is build a strong country," he said. You can't really watch the stock market. Now, if you ask me my opinion on this, the reason that he's probably doing this, guys, is that he does not want to get pressured to change his policies because of the backlash that we've seen in markets right now. We know the markets have largely been following an uncertain and unfavorable narrative towards Trump's policies, but to use the term bullied, he doesn't seem to want to be bullied or back down from his economic plans and economic reforms just because the stock market is throwing a tantrum right now. That is just my opinion as to why he refuses to comment on the direction of the stock market so far and why he keeps saying you can't really watch the stock market, right? Now, moving on further, a detox period from spending. This was raised on Friday. There's going to be a natural adjustment as we move away from public spending to private spending, said Scott Bessent on Friday. The market and the economy have just become hooked on public spending, aka government spending, such as infrastructure bills and whatnot. And we've become addicted to this government spending. And there's going to be a detox period as they move from public to private spending, which is arguably dollar for dollar a better way of doing things and a more efficient way of doing things as well. Now, the National Economic Council Director Kevin Hassett had to say there's a lot of reasons to be extremely bullish about the economy going forward. But for sure, this quarter, there are some blips in the data, including the negative GDP now, which are related both to the Biden inheritance and to some timing effects that are happening ahead of tariffs. So the justification is essentially that they're unwinding a lot of unfavorable for the economy, in their opinion, right? Not my opinion, trying to stay apolitical here. In their opinion, it's just the unwinding of the Biden policies towards the new Trump policies, which are causing all of this disruption. Now, moving on to his further comments, Commerce Secretary Howard Lutnick said, there's going to be no recession in America. He was firm about that. If Donald Trump is bringing growth to America, I would never bet on a recession. No chance. So there you have several comments from several members of the Trump administration. Few economists on Wall Street are expecting a recession. This is true. Goldman Sachs, for instance, cut its GDP outlook for 2025 to 1.7% today. That's the new expectation, down a half a percentage point from the previous forecast of 2.2%, while nudging up the 12-month recession probability to just 20% from 15%. 1.7%, and a lot of analysts and firms have been bringing down their expectation of GDP because of this transition period, but none of them are truly negative. 1.7% is still somewhat in tune to the long-term average of the US economy growth per year on a GDP basis, which is roughly between 1.8 to 2.2%. That is not so negative. So even Goldman Sachs only giving the economy a 20% probability of a recession, down from up from the prior expectation of 15%, but definitely not a very large increase. So those are just a few comments from the Trump administration. Now let's have a look at what analysts had to say about the matter today. After this headline from Bloomberg, stock meltdowns fuels the worst NASDAQ day since 2022. I'll go through a lot of these comments because I want to show you guys what people are thinking overall and in terms of the positioning, both short, medium, and long term. We've gone from animal spirits to what are the odds of a recession. This is true. You might remember when Palantir was trading all the way up here, the SPY and the QQQs were trading excessively high. All the names were running. AppLovin was all these names. Reddit, Robinhood, Coinbase, and MSTR when they had their heyday. Tesla was also running fantastically up here. SoundHound, a stock like HIMS as well, going pretty much, from $27 up to $70, 3x in literally 3 weeks at that point in time. And a lot of people, such as Tom Lee, when they were brought onto networks like CNBC, when trying to justify the outsized rally in a lot of these growth companies and stories, right? Narrative and story-based companies, they were saying that, well, it's because of animal spirits. I'm sure you've heard that term a lot in the last 1.5 months of trading. But now we've gone from animal spirits to what are the odds of a recession? Very, very, very quick narrative shift in the last 3 weeks without much in terms of supporting current economic data. I'm not saying that in the future there may not be forward-looking economic data that may come true, such as a minor resurgence of inflation from the result of tariffs. Keep in mind, though, those numbers will most likely only be available in the next 3 to 6 months. It takes a while for the tariff impacts to make their way into or out of the pockets of consumers overall, and it also takes them a long time to start affecting GDP overall and leading to possible job cuts by corporate America as well, right? So this market largely still based on expectations, on expectancy, not purely fundamentals right now, but we know the market is a forward-looking tool. It tries to price in the worst or best case scenarios as quickly as possible, and right now it seems that it is pricing in the worst case scenario very quickly. Here's what one analyst had to say. I'll also note that many of the biggest sell-offs we've seen in the stock market have started with growth scares and job market worries. Considering the disappointing data we've seen over the past few days, I'd be a little more cautious here if your time frame is a matter of days, weeks, or months. Get defensive and hug your value stocks. Prioritize portfolio balance. So opting for a more defensive stance as opposed to bidding a lot of the high-flying companies, right? I'm a big fan, guys, of continuously DCAing, especially into a lot of the Mag 7 companies, many of which are at fantastic valuations right now, namely Google, namely Amazon, namely NVIDIA, namely Microsoft as well. Those names are truly not going anywhere, right? That being said, Meta is still a little bit high, and Tesla has a slew of problems that it's been dealing with for the last roughly 2 years in terms of demand slowdown for automobiles overall. So if you're avoiding the frothy names and going with the legacy companies that perform fairly well through all markets, a DCA into these companies should be fine. But in terms of trading setups, if you remember on the Saturday video, I did give you a number of value and defensive oriented plays that I think as well could perform quite well if the market environment continues to rotate from the growth sectors over to some more value and defensive names overall. So that I do agree, but notice he said here, if your time frame is days, weeks, or months, if your time frame is years, I still do think it's a fantastic buying opportunities in a lot of the extremely solid tech companies in the market right now that have traded down a lot since their January highs. Let's continue, shall we? So moving on further, this is a period of high uncertainty on a global macro scale, and as a result, we continue to see de-risking in US stocks. Added to the potential geopolitical disruptors are the ongoing narratives. Notice he said narratives of inflation, growth, and now potential recession exacerbated by tariff wars in the US, putting a key word on narratives because we do not have any true recessionary data just yet. Don't forget that. The talks of tariffs is in a lot of ways worse than the implementation of them. That is true. I do not believe the administration knows how the tariff situation will play out, but if I were a betting man, I would say that it will persist long enough to do damage to economic activity for at least a quarter or two, and ultimately result in a deal with different countries that make everyone wonder why we went through all the fuss in the first place, reiterating what the Trump administration was saying, how maybe the first quarter or two could be a little bit bumpy as we go through a detox or adjustment period coming out of government spending. And then thereafter added to the whole picture of Trump's economic policies, such as potential future tax cuts that have to make their way through Congress, not announced just yet. And number two, deregulation, which will arguably help corporate America in a tremendous fashion. Now, moving on further, he also noted that if a tax cut extension and further tax reform bills are passed through budget reconciliation sooner than later, that will help offset the damage, especially the damage from the tariff narratives. Moving on further, from rookie retail traders to hedge fund pros, no one knows what the eventual cost of Trump's sweeping policies really are. This is a very important sentence, guys. Nobody knows, but if judging by the Reddit sections, the Twitter sections, the comment sections of several YouTube videos, everybody nowadays is an economist. Everybody knows exactly what's going to happen as a result of tariffs, even though tariffs have barely been on and we do not know the longevity of the tariffs. We also do not know the retaliation response, nor when they're going to be taken off the table. So no one knows what the eventual cost of Trump's sweeping policies really are. This is true. Not even me, guys, which is why I do not like predicting the direction of the market. We change our trading strategies and adapt for the trading account. For the long-term portfolio, the strategy remains the same. Dollar cost average with every single paycheck into the highest quality companies in the world that have high competitive advantages and large moats. Moving on further, tariffs were supposed to bring manufacturing back to the US and create jobs, but so far, there's little evidence of that. This is also true. Moving on further, actual positioning of both Main Street and institutional investors remains skewed towards long equities. This is also true. This implies that there could be more firepower to unwind if our unstable macro landscapes persists in the coming weeks and months, right? Everybody still, despite what you may think in the markets right now, actual positioning does remain net long overall. Selling pressure, here's in terms of the momentum recently. Selling pressure coming from so-called systematic funds, which take cues from market direction, momentum, rather than fundamentals, could soon ebb, soon taper off, according to Goldman Sachs' trading desk. Meanwhile, TD's trading desk and Citigroup say it's already happening, meaning that all the short sellers and people who have a directional bias, they're all liquidating and capitulating now and potentially starting to unwind some of those positions, which means the selling pressure, at least in the short term, could be looking to come to a somewhat of an end. The actions of this set of quick twitch, algorithm-driven investors is important because their aggressive offloading of shares has been a headwind contributing to the market's tumble as of late. TD says that selling across systematic funds may already have peaked, with commodity trading advisors, or CTAs, capitulating on the majority of their long positions. So there you have it, guys. Several very large trading desks are all saying that potentially we are nearing the closer part of the end of the sell-off rather than the beginning of a continuation of a second leg down, right? Which goes to reiterate what I was saying as well. Very close, guys. When you come into levels such as these, where you have short-term oversold conditions on the US 500, which is the S&P 500 futures, you haven't seen these since 2022. It may just be a culmination, volume climax at the lows, and we may just be looking for a bounce. Now, a bounce is just that. It is only a bounce, but at least for this leg, may be coming to a culmination low. Moving on to the QQQs, same thing. NASDAQ 100 futures, the RSI is a 24. Last time you had that read, I'm glad you asked, was all the way back here, January 2022, and that was the end of the local bottom. But notice how I say the local bottom, because thereafter there was a tremendous bounce, talking about a bounce size of roughly, 9%, which is not nothing, and then the markets rolled over. But this was a different period in time. We had 7-8% inflation, and the Fed was embarking on their fastest rate hiking cycle in the last 25 to 30 years. And also companies had tremendously difficult comparable numbers and were all guiding down for lower and lower EPS for the year overall. So, although we have similar technical indicators, I would say largely that the markets have better positioning at this point in time because we're not in a rate hiking cycle anymore. We do not have 7 to 8% inflation, and company guidance for EPS for the year still remains very positive, especially in some of the large tech players. So that is some of a summary recap in terms of the Trump comments that led to the sell-off and what some analysts had to say, and my final opinion on the matter that I do agree that a short-term local bottom is possibly coming, but any bounce is most likely going to result in a lower high in the markets, which is why if we're looking to get out of any trades that we are trapped in, I would be cautious in saying that when we do get the bounce, don't FOMO the markets and think we're going for the all-time highs. This will be the cue to possibly exit, de-risk in some positions, and then sit in cash if you want to avoid some of the volatility. But definitely, right, capitulating today at the bottoms, well, may not have been the best idea in the world, as we may possibly see some rebounds in the near-term future. One of the catalysts for a possible rebound, well, we have the jobs openings report tomorrow, we have the CPI coming in on the Wednesday session, and on the Thursday session, we have producer price inflation as well. If these reports come in decent, I'm just saying decent, if they don't completely unwind, right? If they come in decent, jobs openings, and the CPI comes in at expectation, that will obviously lead to a Q in market rally recovering, possibly back to the 200-day EMAs, which we have since flushed in the most recent few days of trading. So that is everything for your preview and recap of the comments that led to today's sell-off. Now let's get into something more fun and more lighthearted, which is going to be Oracle earnings. Oracle coming in with their earnings after the bell today, up about 2.16%, but they did miss on a few key metrics. Number one, they missed on EPS by 1.53%, not the largest miss in the world, but they did miss. And they also missed on revenue by about 1.77. Now, companies have beaten both of these numbers and given good guidance and went down 5 to 10%. Why is Oracle, despite missing on both numbers, up right now 2.16, especially in this market, right? You'd expect them to be down 10 right now. Not the case. Let's have a look as to why. Oracle misses on earnings, but touts data center growth for AI. I'll remind you, every single company that has been in the business of AI recently, talking about TSM earnings, ASML earnings, NVIDIA earnings, right? AVGO earnings, which you just got last week. All of them have been saying, and even big tech, all of them have been saying the demand for AI still remains incredibly strong, at least for the next 2 years. Let's look into some of their earnings, shall we? The earnings trailed analyst estimates. We saw the double miss, but the company offered bullish comments on its cloud infrastructure segment. Revenue of the company increased 6% year over year. Net income rose 22% to $2.94 billion. This is good. 20.8% net margins for Oracle. Oracle's net margins, as you can see, profit margin history. This top line is gross margins. Gross margins are back to an expansionary category. Operating margins have been maintained stable and rising as well. And now we can see an increase in profit margins in terms of net margins. This most recent quarter is not on the chart right now, but it's roughly in line, 20.8%. Very decent profit margin increase by Oracle. Revenue in the cloud services business jumped 10% from a year earlier to $11.01 billion. This is 78% of total sales. So you really want to see revenue grow in that cloud services business, and grow it definitely did, double-digit number year over year. The company's cloud infrastructure segment, which helps businesses move workloads out of their own data centers, has been booming due to demand for computing power that can support AI projects. Oracle said revenue in its cloud infrastructure unit increased 49% from a year earlier to $2.7 billion. But you can obviously see most of the money Oracle makes is from cloud services. Cloud infrastructure, although up higher, is only $2.7 billion. We are on schedule to double our data center capacity this calendar year, said Larry Ellison. Customer demand is at record levels. So overall, guys, very decent report from Oracle overall. If you want to go over some more of the numbers, everything was pretty good, guys, in terms of everything, right? EPS was up 20% year over year. Remaining performance obligations, the highlight of this one, right? This is how much money they have in the pipeline, up 62%. Last quarter, when we looked at their earnings, it was only up, well, it was standing at $97 billion. They added an extra $40+ billion in one single quarter to remaining performance obligations. That goes to show you how high the demand actually is. Cloud revenue we saw was up 23%. Infrastructure was up 49%. Cloud applications as well were up 9%. Many lines of businesses, guys, were doing pretty good for Oracle overall, right? Now, moving on further, guys, if you look just at what happened in terms of their margins, right? I just want to highlight it. You can maybe barely see it right now. Let me make it bigger for you. So you can see operating margins right here from 2025, now the year, 30%, and here 28%. So they're growing revenue, but they're also getting more efficient with the business as they grow revenue. And if I pull down here to the cash flow statement, they are bringing a lot of that money to the bottom line. If I can just find it right here, you go. Here's net cash provided by operating activities, 14.6 billion. You remove the capex from that, so you're sitting at a cool $2.5 billion in free cash flow. That is roughly standard with which some quarters that Oracle has had in the past. They spent a lot of money last quarter, which gave them negative free cash flow. If you look here, right, last quarter Q2 of 2024 was minus 2.67. So largely recapturing that free cash flow in this current quarter. Not their best quarter, as you can see. The previous ones are between $3 and $5 billion, but they are coming back to free cash flow positive territory as they spent a lot of money building up those data center applications for their clients. And now they're just looking to ramp back into a profitable state. So overall, guys, not a bad earnings report from Oracle. The one saving grace for them has to be this. It's the massive backlog of orders and the bullish stance on the direction of the AI trade overall. Decent net margins, as we said, decent free cash flow. The only problem with Oracle, guys, is the amount of debt, right? They took on a ton of debt in the most recent few years. You can see that debt right now sits at $94 billion. In terms of all the SaaS plays, guys, this has to be one of the companies with the worst possible balance sheet. They're only sitting on about $10 billion worth of cash. This is why I personally do not invest in Oracle. For me, this debt load will take an incredible amount of time to service, even though they do bring in 10, 11 billion of free cash flow per year. I mean, keep in mind, right? They're not going to use all of it to pay down debt. A lot of that free cash flow has to be used to expand the business as well. So you're talking like a time period of maybe the next 5 to 10 years before you start meaningfully pay down that debt, which is not a problem that a lot of other big tech players have. So the balance sheet for me, this one gets like a B minus, C plus, and I'm being generous. It's just a lot of debt, even though they do make money, they do bring in free cash flow. It's just something that weighs on my perspective of the business so far, which is why I don't invest in Oracle personally. There's companies with much better balance sheets out there. That being said, revenue and EPS growth for the next 3 years is good at 11% revenue, 14% EPS growth, double-digit growth. Their forward price to earnings at 150 where they sit right now, even though they are down right now from their all-time highs, roughly about 24%, guys. A lot of companies are in tech, right? Forward price to earnings of 21.42. It's not all that bad, all things considered, which gives them a PEG ratio. You divide this by their EPS growth rate of 1.53. It's not bad, right? It's not a bad valuation, but is it extremely attractive? No. There's several other companies with better balance sheets, in my opinion, and also better growth, such as Amazon, such as Google, and even Microsoft. Microsoft, I mean, not a better PEG ratio, but just a better balance sheet, more of a solid company overall, and a free cash flow yield of 2.4%. That's quite low. So Oracle, for me right now, it's not a buy. It's not necessarily a sell if you've accumulated a lot of shares in the past few years and you have a tremendous cost basis. I don't see any worries for the business right now. However, for me to really get interested, guys, and trust me, it pains me to say this level, but the support box is on this chart for a reason, right? Oracle, for me, 130 down to 120, I start getting a lot more interested. That would be a top to bottom decline of roughly 35 to 38%. I'm not saying it's going to go there. I'm just saying if it does go there, I would give this company a far greater consideration because the PEG ratio at that point would really be closer to, let's say, a 1.2 PEG. The free cash flow yield would be closer to a 3. It just gives me a much better entry for any long-term positioning. Even for swing trades, guys, in this type of market, it's not really close to any levels whatsoever. You can argue that this guy right here is a bit of resistance, which should be support. But in all reality, right, there's a lot of room to move there to the downside on Oracle before we move into a much more logical area of support. And that is just my take on Oracle. Very decent earnings, fantastic company. At least the best takeaway from this earnings is that the AI trade, I mean, if you didn't get the hint from NVIDIA earnings, from big tech earnings, from TSM earnings, from AVGO earnings, if you didn't get the hint, the AI trade is still very, very, very prevalent. It's just the market right now is unwinding a lot of those frothy growth bets overall. So that's everything I had to show you guys for Oracle earnings. Hopefully you appreciated that. Now let's get into some of the juicy stuff, which is going to be the technical analysis for the disaster that has been the last 3 weeks of trade. All right, so moving into the SPY, guys, well, obviously the daily downtrend at this point simply continues, right? One thing is for sure, we are coming into very, very, very deeply oversold conditions. You can see it on the futures a lot better to the RSI and the NASDAQ 100 futures as well. But on the actual SPY, we are barely coming down to daily oversold conditions. The last time we had this was in August of 2024 when we had the Japanese carry trade unwind. Prior to that was April. So you can see the only times we hit these levels are in periods of time where the narratives really start taking over. We're now below the 200-day EMA. The bears are in full short-term control, but we did hit a few bottoming out catalysts. You can see this 4-hour chart bottoming out right now, 26 on the RSI, right into the support level that I was highlighting, 565 down to about 553. We've used a lot of the support range, and we're also close to the 50 weekly EMA. And that, coupled with the fact that I closed my page, but if you look at the CNN Fear and Greed Index after a day like today, guys, I mean, how much more extreme fear do you actually want to be? Single digits? Everything is extreme fear. Market momentum, extreme fear. Stock price strength, net new highs and lows on the New York Stock Exchange, extreme fear. Stock price breadth, also extreme fear, as many groups and categories have gotten absolutely crushed in the last few weeks and last 1 month of trading. So you're hitting not only oversold technical conditions, we have comments from analysts here, several trading desks, Goldman Sachs, Citigroup, TD Securities. Those are very big trading desks saying that depending on, well, as a result of their analysis, that CTAs and algo-driven funds are now pretty much out, guys. They're pretty much out. They have really sold off everything. Could we be seeing a little bit of short covering and maybe a short-term bounce? Yes, I'm not calling it a bottom for now. I'm not saying tomorrow is green, but you have to take all these oversold catalysts into consideration to the fact that we may be approaching maximum pain on the indexes overall. Any bounce, however, just will be looking for a lower high. The lower high is here, 597. So this point, just looking for a lower high. The 200-day EMA is going to act as resistance. That is 570. And then above that, we have 576 to about 583. If we get a bounce back in the next few days into this area, that could be a possible cue to take some positions off the table if ever you're trapped, because thereafter we're only going to be looking for a possible lower high. And then depending on the bulls and depending on the market narratives, we will see, can they set up for a weekly trend change, or will it just be a weekly lower high into possibly a retest of support and maybe dive even lower overall? This, at this point in time, from top to bottom today, was a 9.2% correction, roughly as equal as we got back in the month of August when we had that Japanese carry trade unwind. So pay special attention to the short-term bottoming out process in the markets. And that is your analysis on the SPY. On the Qs, the analysis remains largely the same as well. Two massive legs of weekly downtrend selling right now. Lower high is set at 512.59. And as I said, we are reacting nicely from the support zone that I labeled, 482 down to 467, running out of runway, however, now below the 50 EMA on the weekly. This does not happen very often, only in times of high peak uncertainty. Top to bottom decline right now on the Qs in the month of August was 15.5%. And right now we're sitting arguably close to that. Top to bottom with the low of today was 13.24. Could we be approaching a close technical bottom as the QQQs are now oversold? The last time we were this oversold, once again, was August. And once again in April, when we had those same inflation concerns. After 2 weeks, 2.5 weeks of just straight shot selling, maybe due for a local bottom. If we do get a bottoming out process in the next few days, we'll be looking possibly for a lower high bounce, the 200 EMA, 491 as resistance, and then above us, 494 to 500. Same concept. If we get a bounce into resistance, if we are trapped, this is possibly a great exit point for some positions you do not want. Settle into cash, maybe write some covered calls, and reassess the situation, rebalance the portfolio if needed. Moving on to the QQQs right now, the XLF financials, same concept. Daily downtrend, sweeping daily downtrend, guys, into daily oversold conditions. The last time we had this was in December after Jerome Powell, after 3 weeks of value getting pretty much destroyed. The time before that, you would have to go back a long time, guys. The fall of 2023, not quite close to the 200-day EMA. 46.8 is the 200 EMA on this one. And support level right now, 48.31 to 46.8. Now, same concept. Short-term timeframes do appear to be oversold. Several names in financials, namely the banks, are at oversold levels as well. You can take a look at Bank of America. Deep daily oversold at this point, 24 on the RSI for Bank of America, into huge level of support. The last roughly how long, guys? 4 years, 3 years worth of support, this zone right there. Wells Fargo Corporation on the daily time frame as well. Deeply daily oversold at this point in time. JP Morgan at this point in time. JP Morgan, 24 on the RSI, deeply daily oversold. When's the last time JP Morgan hit this? The fall of 2023 at the local bottom of that time, reacting from its own 200-day moving average. Top to bottom decline on JP Morgan, 17% in 3 short weeks. Usually does not happen, but when it does, it could be a short-term bottoming out indicator for the markets. Keep in mind, though, Any bounce will just be looking for a lower high. Depending on the size of the bounce, the bulls will either have a chance at recapturing, or if the bounce is too weak, we will just revisit the lower end of this support range and possibly move lower. At that point, the next area would be $46 to about $45. Moving on to healthcare right now. Healthcare was somewhat resilient in the morning before giving back most of the gains. This is one still sector that is still somewhat in the context of a daily uptrend. However, keep in mind you flush 147.24. We're almost there. That, without any new highs, would be a daily downtrend and possibly the start of weekly consolidation on healthcare as well. If you zoom in a little bit, the lower high is the higher low, is 144. Any move lower, just looking for a higher low for possible further trend continuation. A few key supports below us, namely this whole area, horizontal level, which ends at 146.42, and the moving average is slightly below that. We will see if the healthcare bulls have it in them to complete this inverse head and shoulders pattern and go for more, as healthcare is known as one of the more defensive sectors out there. I'll remind you, I gave you a few plays over the course of the Saturday video. UNH in this level, not a bad trade in my opinion, and also TMO in this huge level right here, also not a bad trade in my opinion for some long side hedging for healthcare. Now, moving into semiconductors, one of the biggest losers of today, and we're going to take a look at some of these names, right? ASML, this one down 7%. TSM, this one down 3.64%. And we'll look at a few other ones. If you take a look at the heat map right here, Broadcom down 5.3, giving back largely all of its gains. But just look at this list, guys. MCHP 10% to the bottom side of the list, Micron 6.3, Qualcomm 4 almost, AMD down 3.67. So obviously not a very good day for semiconductors overall. That being said, guys, semiconductors breaking below a key area. We've been holding the support level since pretty much the Japanese carry trade unwind, which saw a similar decline. You maybe don't remember it this far back, but this was a much steeper decline. Top to bottom, in 4 weeks, you're talking 30%. So I know that the markets appear dire right now, but this is only, and I say only because it's still a pretty big move, 17%. It is half of the move that we got all the way back here, right? This was a much more violent move to the downside. That being said, the weekly candle is not closed, so I will not move this box to resistance. That being said, not quite daily oversold, but the short-term bulls have their work cut out for them, right? This is just a sweeping daily downtrend at this point. Lower highs are set 230. Any move higher, just going to be looking for a lower high. Depending on the size of the bounce, you will need the bulls to reset into a daily uptrend if you want this weekly candle to start to recover and pop back into support. Not looking the best right now. Next area of support for the bulls is at $200 flat for these markets. My favorite way of playing the volatility in this is, as I was saying in yesterday's top 5 option video, riding short puts way under the market, benefiting from all the volatility. There was some fantastic contracts available, guys, on NVIDIA, all the way down to the lower $90 range for some short puts for just the Friday session. So semiconductors looking weak, but a lot of trade left for the rest of the week. Now, moving on to IWM Russell, definitely not a place that you want to be in the context of a growth scare is the Russell. Top to bottom, since the highs of roughly end of November, was 18% to the downside. The index, one of the indexes leading the industry, leading the markets to the downside, right? Weekly, sweeping weekly downtrend into the 200 weekly EMA as well. This index too has now hit oversold conditions. The Russell is less of a stranger to oversold conditions, but to get this oversold, you would once again also have to go back to January of 2022, approaching the next area of resistance, which roughly sits where we are kind of right now, right? This box should be at 200 psychological. Let me just move it up ever so slightly here just to encompass a few more candles here and there, right? So pretty much 200 down to about $190 is the next approaching support area, but any bounce, we'll just be looking, guys, for a, what do we call it, right? Lower high, right? And then it's up to the bulls to prove to us, can we get back enough of this move to reset into a daily uptrend, or will we just encounter the short end of resistance and come right back? But any moves right now are just looking for lower highs because we now have lost the weekly timeframes, the daily timeframes as well. So any bounces, guys, you need to be very patient before positioning in the Russell. I do not think this is the best place to put your money in the current market environment. Not financial advice, of course. Moving into Dow Jones right now. Dow Jones also flushing its own 200-day moving average. The last time that happened, you'd have to go back a while, was in the fall of 2023 when you have similar growth scares and similar inflation concerns as well. Moving on further, daily downtrend is now clear as day for the Dow Jones, with lower highs being set at around $43,000. So now 43,000 points rather, if you do get a bounce resulting from not quite short-term oversold on the daily, but the 4-hour is definitely coming into there and the rest of the markets are. If you get a daily bounce, you need to watch for the size of the bounce, and then it's up to the bulls to reset the daily uptrend. Overhead resistance stays put at 43K up to about 43.3. So before claiming that this could be a local market bottom, you have to wait for the bulls to make their move. If not, we can drop a bit lower. If we just flush through this area, the next big line of defense is 41,003 down to about 40,500, levels that we had not hit since the month of August. So keep that in mind. Top to bottom declines now on the Dow Jones is about 7%. So not as aggressive as the SPY or the QQQs, but still down a lot for the Dow Jones, which has more of a defensive connotation to it. Now, other minor sectors are somewhere up on the day, somewhere down. Consumer defensives, they were up on the day, but now tapering back, which tells me that even the move in value, guys, might be getting tapped out. What does that mean? I'm not willing to call it right now, but when you see a curling of possible value, right? Look at SCHD, the dividend ETF. You see a curling of this move right now. Look at the daily, right? You see a curling. Is it maybe time after 3 weeks of rotation? Is it maybe time for a bottoming out process in tech and a rotation back, short-term rotation back into tech and a rotation down in value? Possibly. We have to pay special attention to this, which is why I was telling you guys on Saturday's video, do not chase value names that have ran a ton towards their all-time highs. Try to find the ones that are still relatively artificially low, such as Pepsi, such as UPS, such as other names in defense, such as GD, which ran a ton today, such as Lockheed Martin, right? They're all still relatively low, as opposed to names like Johnson & Johnson, which just clipped into, arguably a very huge move to the upside. Coca-Cola as well, clipped into a very huge move to the upside. McDonald's, right? Huge move to the upside, all-time highs as well. So you want to stay focused, even within value, on the names that haven't ran as much as the rest, right? And utilities and real estate are the same, namely pulling back a lot from their daily highs. They were up 1% overall today, more than 1%, and then they ended the day red. Names like Vici, right? Huge move to the upside. Vici was up 3%, gave it all back. We might just be seeing that rotation away. Realty Income Corporation up 3 weeks. Culmination candle, doji, shooting star, call it what you will. Maybe just the topping out of that value rotation for now, because you'd still be looking for higher lows for possible further trend continuation, right? But is this maybe the end of a 3-week heavy push in some value names? Maybe. We'll see. That's why I tell you guys to study the rotation. VIX as well, peaking at almost 30 today, guys. It almost hit 30 today. And we know when the VIX is high, you want to be buying. Not the VIX, but you want to be buying everything else that's been crushed, right? Especially when it comes into 30 plus ranges. All of these have been very good buying opportunities. So at least if you're not a fan of trading the markets during volatility, I hope and pray that you guys have been adding at least some shares and some money to your long-term portfolios amidst this sell-off process. I'm never going to be the person that's going to tell you on this channel, guys, that the bottom is truly in or not. I can make some attempts at local bottoms, but I will never on this channel say that the actual market bottom is in for a long-term portfolio. The best you can do is dollar cost average with every single paycheck the whole time that the markets are drawing down into your favorite companies, the highest quality, highest conviction companies that you have, right? That have very solid and resilient business models, right? That have been around for the past 10, 15, 20, 25 years, delivering outstanding returns. Maybe they're down a lot. I gave a few examples on the Saturday video. And if they are, it's a great time to be starting to add to your long-term portfolios. The last thing you want to be doing is getting scared out of the market, especially if you have a good job, you have a nice salary. You should be dollar cost averaging into the portfolios. Don't take it from me, guys. The best investors of all time have told everybody to do this consistently, and most of the gains are made when you are getting used to buying the pain all throughout these market sell-offs into oversold conditions, right? Now, moving on to the bonds, you would expect the bonds as a fear trade to be skyrocketing today. The bonds not skyrocketing at all, only up 1%, which is a very good day, I will admit that, but definitely not a fear-driven rally. You would expect these 20-year yields, if you really expect the US economy to go into a massive recession, or at least if analysts do, right? you would expect the TLTs to be currently rallying right now, really going back and sending the 10 and 20-year yields at least back down to 4%. I mean, the consensus right now for the December ending period for the amount of rate cuts, this is from the Fed Watch tool, the consensus right now has moved from 1 rate cut for the year to now 3 or 4 rate cuts for the year. So why is TLT not flying? Because inflation might be a concern? Well, it's kind of an oxymoron. If you're thinking that we might get an economic downturn from tariffs, well, how are tariffs going to lead to inflation if everybody's going to lose their job and stop spending money, right? They're going to be a counterbalancing force right there, which leads us to believe that maybe the Fed will be able to cut the rates, not to 0, that's not what we're saying, but at least 3-4 cuts this year. Why are the bonds, the long-term yields, not absolutely skyrocketing? Very curious, right? Also similar. Gold, if the economy is really heading into dire straits and people are looking for protection, why is gold not skyrocketing just yet as well? Maybe, just maybe, it's because that we're going through an expectancy, negative market sentiment, and negative narrative right now, more so than actual concerns about a real-based recession, right? Until we have the data, the big rotations into these safe haven assets, in my opinion, will be somewhat muted. I'm still a big fan of buying bonds down here because whatever happens, I do believe rates are going to come down. Not to 0, but they will come down, and that pressure will eventually be felt in TLT, especially if more people rotate from stocks to bonds and cash. You will have a rotation here on the TLTs. Fantastic area to be buying, 90 all the way down to about $88 if you have a long enough time horizon in the next few months for a volatility protection trade. Now, moving on further, Bitcoin, got to talk about Bitcoin today. Bitcoin down 1.65%. It was down a little bit more throughout the day, but now down, or sorry, this was the day yesterday, down 6.39%. Ethereum starting a brand new day, down another 7%. I forgot daylight savings time. We're now an hour pretty much back. So that being the case, what's going to happen right now is the fact that we have 2 new candles. This was yesterday, or the day, or today rather. This is the new candle that should have started at 7 p.m. Eastern. This candle literally started like 15 minutes ago, pretty much. So that being said, Bitcoin down 1.5% again today after a 6.5% day. Was saying this the whole time, guys. Who's in control of this chart? It is a daily downtrend breakdown from resistance 92 to about 88,000, breakdown from the 200 daily moving average. So when in doubt, zoom out and look below as well. 73,000 down to 67,000 is the next big area of support. But at this point in time, we're so close to it, I think we're probably going to get that flush down into here because there's just been a move away from risk on assets to risk off assets. And Bitcoin, you can say what you want. I'm still a big believer in Bitcoin, 3, 5, 10-year time horizon, yes. But the risk off move has been felt across the markets and probably will be, maintained in Bitcoin as well. That being said, any bounce looking for a lower high, it's up to the bulls then to prove to us, do they want the trend back? But if the market sentiment is any indicator, short-term bounce might just be met with a little bit more selling until we make our way progressively down into the larger area. As a result, I will be patient and wait for this area before any more incremental buys. And that goes the same thing with the rest of crypto, guys. Anytime Bitcoin moves down, the rest of crypto will get hit even further. So altcoins, I'm not a big fan in positioning for them at all. I was telling you guys all the way up here, was I bidding altcoins? Yes, but very small. Over the course of 3 months of my total altcoin allocation, I got up to a whopping 10%. 10% of the available capital I wanted to put in altcoins, I put. Now I've stopped, right? Now we're just going to wait for local bottoms to be formed, and then we can possibly talk about the future of a Bitcoin rally or the future of an altcoin rally. But as of right now, it's just not here. And now let's dive into the last portion of the video, which is going to be our big tech stocks, right? Give me a quick second. No coffee just yet. Moving on to Apple right now. So Apple was at one point down 6%. Its worst day since the sell-off in COVID, March 20 of 2020. That was the day that Apple went down over 6%. It did not close down 6%, but this was an over 6% sell down on Apple. Why? Well, there's a few negative headlines right now to Apple. The number one being Apple delays AI enhancements to Siri until 2026. And as a result, you don't see it in this article, but iPhone sales growth was pushed back from 5% to 2% for the next year, which is not very good at all here, guys. That is why Apple stock was down 6% today. And I was saying Apple was really an anomaly. It was holding up price action better than expected. And I had my doubts. Why? Because, well, they were only growing revenue at 5% per year. Now they might be a little bit lower, and they have the highest valuation by far of all the stocks in the Magnificent Seven. So to see Apple before today from the recent highs in February when the markets really started selling off to see them only down 4% when other names here are down 15, 20, 25%, something just wasn't right. And now Apple also joining the mix. So Apple daily downtrend at this point simply continues. Let me just get my brush. Simply continues daily downtrend, right? Looking for the lows into support right now, 225 to 215. I'm still not buying Apple despite touching the 200 AMA, not daily oversold and still only off its highs. I mean, I'm saying only, but still only down 12%. There's better buys in the market right now than Apple. Apple has a too low growth rate for me, too high of a valuation, even though it's come down, too low of a free cash flow yield. Several other companies that we're going to take a look at shortly have much better fundamentals. If push comes to shove and this head and shoulders patterns plays out on Apple, we can test the lower range of 215, but I would not be surprised if push comes to shove over the course of this year. If the markets truly do what some people think they're going to do, I'd be looking at Apple maybe at 200, guys. I'm still holding all my long-term shares, but I do not believe Apple represents the best swing trade capacity right here. Number one, it's not even daily oversold. And number two, the valuation is quite high and can get compressed a little bit more, as we've seen in the rest of big tech. All that being said, Apple still holding up as one of the best names in the market so far. Now, moving into our next one, which is going to be AMD. So AMD down 3.67% today overall, and just extending the sell-offs, even further. We know AMD has been no stranger to selling off. They call it advanced money destroyer. Monthly downtrend is clear as day for the last 7 months or 6 months in a row, guys. Not much upside on AMD whatsoever. The weekly downtrend persists at this current time. And in terms of daily, well, we're barely approaching daily oversold conditions, looking for maybe even more follow-through for the bears. At this point, if the bears do follow through and flush our last line of defense, which we're kind of coming up on it now, guys, we are going all the way lower. I hate to say it, all the way down to roughly $83, which would be crazy valuation on AMD. I'm still very bullish on AMD overall for not only this year, but 2026. It may take a while to turn around, but I do believe that any shares purchased, and notice I say shares because we're moving away from call options right now. I do not think it's the best bet, right? Any shares purchased here probably will be rewarded handsomely in the next 2 years at some point, but you may have to be a little bit patient with this one. The valuation is still extremely, extremely cheap. It's now probably like a 0.5, 0.45 peg it's maybe approaching right now. Revenue and EPS growth are fantastic. The growth prospects of the company are fantastic. From AMD's earnings themselves, from NVIDIA, from TSM, from ASML, from AVGO, and now from Oracle, the AI trade has still heavy amounts of demand, and I do believe that any shares purchased on AMD here should have a very good chance of being rewarded, but I'm not going to call a temporary bottom when the SPY and QQQs are in absolute free fall mode. It's up to the bulls to prove it to us. Can we get a new daily uptrend and start attacking the higher end of this resistance around the 112? Only then can we start talking about the bulls' capacity to reset the monthly and put an end to this long leg of monthly consolidation. But as of right now, not quite oversold enough for me to be saying that this is maybe a overall local bottom for the stock. We will see how the next few days of trade play out. Moving on to Amazon right now. Amazon also down 2.36%. One of the lesser declines of big tech for today, but still a decline nevertheless. Amazon now in daily oversold conditions. You guys know I'm a big fan of buying daily oversold conditions and when a stock is down 20+% from the Mag 7 from the all-time highs. I will remove Tesla from the Mag 7. I'll call it the Mag 6 for now because Tesla has its own concerns, right? It can go down to far more than the rest of these companies can. Still below its 200-day EMA, and still the bears in full absolute control of this sweeping daily downtrend. The lower highs are right here, 209.31. So any oversold bounces right now will be looking for a lower high. How high can the bulls get with this bounce? If they can get to a 618 or a 782 retracement size, you can just do this by throwing the fibs top to bottom. If they can get a good bounce to 2 or above the 200-day EMA, the bulls have a great chance of setting up for a short-term daily uptrend recapture. However, on the weekly, we will still just be looking for a lower high. And then depending on the size of the daily uptrend, right? If you can continue this daily uptrend for a while and get us a nice weekly bounce, then we can talk about the bull's ability to reset the weekly uptrend. But one thing at a time. The daily comes first. You need to see the daily bulls recapture. Right now, though, reacting nicely from support, 196 down to about 186. All this resistance here proving to be good for Amazon. Fantastic area for an attempt at a swing trade long to the highs, but also a fantastic area to be adding some long-term shares to your long-term portfolio if Amazon is a company that you want to hold in your portfolio for the next 5, 10 plus years. Moving on to Google right now. Google down 4.52%. crushing the lows from last week, setting a new daily leg to the downside with a lower low, reacting from the 200-day EMA as resistance at that point in time. Any bounce, I'll remind you, need to reset the daily uptrend, right? Daily downtrend, clear as day, into support. Yes, 175 down to about 162. However, we are also now in a bit of divergence. Lower lows on the price, higher lows on the RSI. This is known as bullish divergence, right? So you might just be looking at the capacity for Google to bounce. If the rest of the markets bounce and Google bounces as well, and we can get close to 176, you're going to get a somewhat engulfing move, can reset the daily uptrend to the bulls, give ourselves a little bit of a daily uptrend rally, but on the weekly, just looking for a lower high. And then depending on the size of that move, we can then talk about either recapture, or if it's too weak, we can talk about possibly lower lows and testing the bottom of support. All in all, though, fantastic location to be adding Google to your long-term portfolio. If it's a company that you like, the valuation does support a add right now. The PE ratio is low, the PEG ratio is low, free cash flow is fantastic, margins are fantastic as well. Moving on to Meta right now. So Meta down 4.42%. At one point today, Meta was down over 5.5% top to bottom. So daily downtrend persists right now with the lower highs still set at 659. Now, I'll remind you as well, Meta starting to come into oversold conditions where, well, into the next big area of support, a much better level than the one we had here. This is a big one, right? From October, 599, let's call it 600, down to roughly 576, culmination in the 200-day EMA. So if we do get a bounce on Meta, same logic applies. The size of the bounce is crucial. Can we get back above this resistance and give ourselves a short-term daily uptrend, get some reprieve to this massive sell-off, which is a big engulfing move, get possibly a lower high, then depending on the size of the bounce, we can then evaluate whether the bulls are ready for a new weekly uptrend shift or whether we just start piling onto the losses here and give ourselves more monthly consolidation on Meta, the end of which might just culminate 550 down to roughly 500. That would be a fantastic level to add Meta. That will be top to bottom declines of 27 to 30%. I'm not saying it's going to go there. I'm just saying that my entry category for Meta does sit below 550 down to roughly 520. I would not mind adding some long-term shares to my portfolio, but right now at around 592, the valuation is still a little bit high. I know we last did it at roughly $676, but if you want me to redo it right now at roughly 592 in the after hours, we can do it right now together. This EPS number has not changed. So 592, right? You divide 592 by their EPS, 22.69 on a forward basis, you get a forward price to earnings of 26.09. And then if you divide that further by their EPS growth rate of 13%, you get a forward PEG of 2, which is still high in consideration to the rest of our tech names, such as Amazon at a 1.5 and such as Google at a 1.35 at 180, now almost 8% lower. This should be closer to like a 1.25, right? So Meta, still a little bit richly valued, even though the company is doing fantastic and has great guidance for the next year. Still a little bit rich in my opinion. Moving on to Microsoft. Microsoft down 3.34% today, also extending declines, no secret there. So daily lower highs are set, lower lows are set now as well. And that's the weekly time frame. Daily downtrend is not much better. You can see clear daily downtrend legs right here. Lower high is set at around 401. Now, the week is not yet finished, so I'm not going to close this resistance or support box into a red box right now. Still a lot of trade left for the week. We'll see if the bulls can recapture. Where did we react from today? The lower box that I pointed at in yesterday's top 5 options, 378 down to roughly 364. It is these guys here from December of 2023. Yes, Microsoft with no gains in the last year and 3 months worth of trade. Top to bottom decline right now is sitting roughly at 20% from the all-time highs. Usually a very good buying proposition for Microsoft and coming into daily oversold conditions very shortly as well. If you do get a bounce though, keep in mind, have to change the daily time frame first. Nice bounce move and then go for the trend change. They tried it here and got unwound after today's move. Maybe now they can have a little bit of smooth sailing, try and reset, right? If we don't reset, we're going a lot lower into the 365 range, looking for daily oversold, and then we will redo the analysis, waiting for that first daily uptrend. Only then do you know the weekly legs down of selling are finished, and you're looking for a bounce play to possibly make some better educated decisions as to where the markets are going to go in the medium term. But for now, it's basically selling only. But This is another fantastic company at another decent valuation in terms of historical averages. And right now at 379, if you want me to redo the valuation, because right now it's getting pretty juicy, guys. Not gonna lie, it is getting pretty juicy on Microsoft. Let me just check the EPS right now. I'll redo these right in front of you guys. 1315, a little bit higher, right? Incrementally higher. It's not going to change the calculation by too much. But if we wanted to redo this real quick, right? 380 divided by 1315, you're now under a 30 price to earnings for Microsoft, which doesn't happen that much on a forward basis. You divide that by their EPS growth rate, which is roughly 14.5, you come to a PEG ratio under 2, right? Microsoft, not usually there because Microsoft trades a little bit rich traditionally, right? Getting very attractive to add some shares to any long-term portfolio if Microsoft is a company that you see yourself holding for the next 5 to 10 years. Moving on to Netflix right now, down itself 2.74%. Top to bottom move on Netflix right now is currently sitting at roughly 19% to the downside. Daily oversold conditions as well, but conversely, to its peers here, we are not really in a big area of support. Yes, it's a last line right here at the 826 level, but there's really not much there overall, right? So Netflix, same thing. Daily downtrend is very pronounced right now. Any short-term bounce as a result of daily oversold conditions, looking for a lower high, and then it's up to the bulls. How high can we bounce to get a daily uptrend back? If you bounce very shallow and get rejected by this resistance, which is roughly 935 to about 900, well, of course, the likelihood of you heading for one leg lower, maybe into the 200-day EMA of 805, is highly probable at this point. Weekly, well, although we are still in a weekly uptrend right now, we know that we ran completely out of momentum. So at this point in time, the best case scenario is a tightening range because at this point, a V shape to the all-time highs after this much retracement is highly unlikely. The more probable scenario, the best one for the bulls, is a tightening range close to the all-time highs. The worst one, of course, is just a lower high, shallow, into lower low, weekly downtrend into further monthly consolidation, which could see consolidation have all the way down to around 792. Now, we did the valuation lastly at about 1,000. If you guys want me to redo it real quick, at about 860. Let's call it 860 for this valuation. These numbers haven't really changed. We'll check the EPS just to make sure. It hasn't really changed, right? They updated slightly after their earnings. 2481. I stand mistaken. That's why I check it. 2481. A little bit of an update here, a little bit of an increase by Wall Street. So let's do the valuation together because before it was a 1.83 peg. So at 860, right? 860 divided by your 2481 is 34.6. Still amongst the more rich names of the Mag 7 that we've seen recently, right? Divided by your 23% EPS growth rate, you're saying at a 1.5 peg. It's not terrible. It's not terrible, but also not cheap. Not a bad location to nibble some Netflix, but if you ask me, I would much rather find it around the $800 mark. So we'll revisit this one if it comes down to it. Moving into NVIDIA right now. NVIDIA down 5% on the day and an extra 1% in the after hours. NVIDIA just cannot catch a break, can it? Daily downtrend is clear as day right now. Lower highs are set 118, breaking lower than our line of defense support region right here. Well, as a matter of fact, right? You can argue that it does extend a little bit lower here, all the way down to roughly 100 psychological, right? If you want to just extend this a little bit to capture the rest of these candles, $100 psychological is going to be that final level, but very, very, very volatile candles, right? It has similar fallback during the month of August, right? Top to bottom. Right now, if we take the top of this move to the bottom right now, 25%, put us into about 100. That'll be your 30% drawdown on NVIDIA. So daily downtrend continues. We're going to need to eventually see a bounce move by the bulls, get the daily uptrend back, and that is to salvage the last line of defense before the $100 psychological level breaks. Go below that, there's another big one down here at about $95 to roughly $79. That's where we found more support in the month of August overall. I'm overall a big fan of buying NVIDIA down here. Even at 106, we did the valuation literally just a few days ago on the channel. At 115, it was a 1.10 peg. Right now, 10% lower than this. This is going to be around a 1 peg for NVIDIA for all the growth they're having in the future. This is just heavy monthly consolidation, right? Monthly uptrend, monthly big consolidation. Could we possibly see a retest down here? It could be possible, guys, but I will be adding to some NVIDIA shares if we break down below that 100 level. I would like to add with short puts. Writing short puts down in the mid 90s, not a bad proposition overall. You can see our monthly MACD is curling over for the first month since this entire rally started early 2023. So on the 3-month time frame, right, you can go down there. You can go all the way down to like $90, $80, and nobody would be surprised, guys. It's a very overbought chart. But at that point in time, It would be extremely cheap. I'm not saying it's going down there, not in one clean shot, but if it does go down there, $90 to $80 is where I want to be buying this one specifically. Moving on to Tesla right now. So Tesla, look at the RSI on this one, 20.59, 15.5% move to the downside for a few factors, right? Tesla's been having some very weak data come out in terms of different countries, right? China's sales are down, sales all over Asia are down, sales across Europe are down, US sales are tapering back as well. We're starting to see some instances of vandalism against Tesla's overall. The brand sentiment surrounding Elon Musk as he concerns himself in the world of politics rather than focusing on the company is weighing on investor sentiment as well. A lot of volatility events for Tesla right now. It has now fallen since the peaks of December prior to Jerome Powell, 55%. So Tesla is no stranger to volatility. I'll remind you, you look at the chart and the history of the chart, right? No stranger to volatility. Huge moves to the upside, huge moves to the downside. You remember on the channel, I was saying this move didn't really make sense. It was all hype based. And now you're getting an absolute removal of all that hype. And now hype turning into absolute pure fear and capitulation for Tesla shareholders right now, down another 1.6% in the after hours. Coming into support though, 220 down to 200, about 193. I would not be surprised if these levels are achieved perhaps in the next week of trade. Yes, we are daily oversold, but the bears right here are just too strong. And the negative sentiment around the stock and the brand right now is also just too strong. What I need to see for a bottoming out process is reacting nicely from the support zone, give me a good bounce and establish a base of support. Until that time happens, I cannot say that I'm interested in touching this one just yet, even if we are coming into a location of support, right? The market is not location, location, location. Just because it's coming into an area doesn't mean that the bears have to respect it, right? Here, it did happen after a similar decline from 400 down to roughly the same area as we are right now. You can see big, hard move down, but then we got a basing out of support. That's what allows you to take more educated trades rather than just trying to catch falling knives. So that is something that I'll be looking out for on Tesla stock specifically. Moving on to Palantir right now, down 10% as well on Palantir. The growth story unraveling, right? I redid the valuation today for my Discord members at $78. It is still a forward price to earnings of 144. It is still a peg of 5.15. Anything above 2 is expensive. This is double and a half what usually is expensive, and a forward price to sales of 29.5. All metrics are still extremely expensive for Palantir, guys. Look at this monthly candle, right? It leads me to believe that further consolidation for Palantir is going to continuously be underway. I'm not saying it's going all the way down here. It might. Who knows? It might. But can we see some sideways action as Palantir grows into its new valuation, at least maybe until next earnings, which could be the next bullish catalyst? Yes, absolutely. And you have to open your mind to that possibility, right? We can't only put on the bull goggles when it suits us, but we can't also say that this stock is going to get absolutely crushed and go back to $30, $40. That would be fair value, but there's a lot of retail momentum, a lot of institutional interest in this company as well. So we cannot count Palantir down and out just yet. That being said, I'm not going to be a buyer until perhaps we pull back sub $60. That is when, even if it would be still fundamentally overvalued, this would be an area where I'd be more comfortable taking a position. As of right now, though, down top to bottom, almost 40%. A lot of this last move here, guys, was pure squeeze, pure hype momentum, right? That being said, daily downtrend objectively is still underway. Your lower high is right here, 90.4, and we're now breaking down below this short-term area of support, which was prior resistance. The next one is 72 down to $66. That is just objective analysis on the stock, right? Those are the levels. I'm not saying it's going to crack down and break down below. The 200, however, is at $60, which is why I want to be going shopping there. You've noticed that I'm going shopping on all the ones that are at or below their 200s and daily oversold. Palantir is just not there yet. So although it can bounce from here, maybe, who knows, maybe this is the bottom. It just does not respect my criteria in this current market to issue a buy, as it is not daily oversold, nor is it touching or moving below its 200-day moving average. So that being said, the bulls are looking for a heck of a bounce, and then they need to reset the daily uptrend if you want to put a stop to this weekly momentum to the downside. That being said, the bulls have now given back around 70-75% of the move. So maybe the best possible thing that can happen to Palantir is some form of a tightening range. But at this time, I think you guys can probably understand that an all-time high V-shaped breakout pattern is probably somewhat unlikely, especially for the fact that we do not have earnings until the month of May. Moving on to SOFI right now. So SOFI as well, down 11.2%, down another 1.61 in the after hours. Are we moving lower in the after hours? not so much, but some momentum continuation selling on a lot of the hype plays, right? As people just, I guess, come in after work and on their Robinhood brokerages, they just start selling off. Now, this one does respect my entry criteria. We are now daily oversold. The last time we were daily oversold on SOFI comes all the way back down here, September of 2023. You notice some parallels. A lot of these have not sold off this aggressively into daily oversold since September of 2023. That being said, below the 200 EMA and into support 1170 down to about 950. This entire region is a region where I want to be buying SOFI, but buying SOFI slowly because there's a lot of momentum to the downside, right? And I'm not a fan of blindly catching a falling knife with a full size position. Slowly, slowly, slowly. Wait for the bears to show you where the bottom is. Lower high right now is 14.9. That being said, still no bottom in sight just yet. Eventually, the bulls will need to have a nice bounce, 50, 60% bounce. Then we can talk about the capacity for a daily uptrend recapture. If you only bounce 30% before rolling over again, the odds of you coming lower and lower are highly, highly, highly stronger, right? That being said, the next big area where we actually run into some candles is $10 because now it's just the start of the IPO range and these guys back here. But closest price action has to be the lower $10 range. I will continue to buy SOFI all the way through this dip. However, slowly pace yourself because eventually you want to see the bulls when they're done the move, right? I don't know if it's here, maybe it is, but we're going to need to see some form of a consolidation range eventually and a recapture of the daily uptrend and a weekly low set. That being said, even with a new daily uptrend from here, okay, you'll only be looking for a weekly lower high because it's a weekly downtrend, lower high, and then a V shape like this is highly unlikely, guys. You got to get that out of your heads, right? It'll be a long duration recovery process and we will play the price action all throughout that time. But resistance right now stays put, $14 to start. And that is everything for today's video. We went over a lot of stocks on the Saturday video. I also gave you a bunch of plays on the top 5 options. So I will not be going over everything that happened on every single stock today. Maybe we can do a little bit more of it tomorrow because tomorrow I'm probably not going to be covering any of these earnings. So we'll be covering a lot more stock specific stuff. However, if you enjoyed today's video and the recap, consider dropping a like. I would really appreciate it for the growth of the channel. Consider subscribing to the channel if you're new. We do these videos every Monday through Friday after the close. The videos in the next few days will be a lot shorter because tomorrow I don't have that much in terms of recap headlines to give unless something huge happens. I think now we've gone over everything. We've gone over the growth scares, the growth crush, Oracle earnings, spent a lot of time on that one as well. And now you guys know the expectations. So the videos moving forward this week should be considerably shorter than the one Saturday and the one today. But thank you very much for watching this far nevertheless. And if you have any questions, of course, feel free to leave them down below in the comments section. I'll answer them all tonight. And in the event you guys want me to hold your hand and you guys want to be a part of the private Discord right here with several hundreds of other members and get access to all of my trades in real time. These are all the trades since the inception of the Discord. The green check marks are wins. The little red ones are losses. I want to have access to all these trades. We do the wheel strategy, selling puts in the market amidst this volatility, call options, put options, call debit spreads, put credit spreads, share trades, long-term portfolio trades as well. All of these trades are offered as a service in the Discord. We also do private morning live streams every Monday through Friday. So if you want to ask me any questions on your stocks, your options, your long-term portfolios, you can ask them in the live stream. If you cannot attend, all the live streams are recorded, of course. You can watch them later. And you can also ask me all your questions in our chat rooms, and I'm usually very fast to answer all throughout the day. You also get access to my private videos where I show all the advanced level strategies, not only for the wheel, but for spread trades, also for possible bear market videos, technical analysis videos, how to do technical analysis the way that I do it as well, and several psychology of the market videos as well, which our members have been finding tremendous value in, especially recently. And also you get access to all my watch lists, every single one of my watch lists, and all my charts, all my technical analysis, my support, my resistance boxes. And additionally, anytime I do annotations on charts for earnings, such as I just did on over 100+ companies, with the click of a button, copy paste, you can copy paste all my watch lists, all my charts, all my annotations, and support resistance boxes. If any of that interests you, the link to the Discord is down below. And if not, I guess I'll see you back on the channel, guys. So thanks so much once again. Manage your stress and anxiety accordingly. I know the volatility brings a lot of stress, anxiety out of people. When the market closes, guys, I want your minds to go a little bit to off mode, right? Don't carry stress, all right? Stress of losing money or stress of the markets into your personal relationships especially not into your professional relationships at work. Do not be irritable in such a market environment at work when we know that the jobs market or whatnot, you want to act as if nothing happened, right? Still be a very good coworker, work hard, don't disappoint your superiors, right? Do as much as you can in the workplace at this point in time. Save as much money as you can from your income as well, so you have that money to invest, right? So quick little tidbit on psychology of getting through these sell-off environments. So that being said, love you guys as always. I'll see you tomorrow after the close. Take care and peace.